It's panic in the White House as inflation soars and midterms loom. I'm your host, Steven Van Metre. Thanks for joining me today. And over the past couple of months, we've been talking about how inflation would quickly become a political issue. Well, that day is here now. You're about to see why the White House is giving the Fed the green light to send the economy into recession and stocks crashing. Let's head over to Bloomberg, where we picked today's story up with the headline that Biden, in rare Powell meeting, seeks to deflect inflation blame. Meeting with Powell recalls the Reagan-Volcker gathering in 1984 as high prices a top priority for voters ahead of midterms. And what's the deal with Volcker? Well, he was the Fed chief between 1979 and 87. And what notably happened is you see these gray bars. These are recessions. There was a mild recession right at where inflation peaked, and a much deeper recession that brought inflation down. And ever since then, you'll notice that where there's high inflation, you'll see a recession. And every time following, inflation comes down. And that is the signal the White House is starting to give the Fed: bring the economy down at all costs, because we need to get inflation under control and fast. President Joe Biden used a rare meeting with Fed Chair Reserve Jerome Powell to declare that he's respecting the central bank's independence while simultaneously shifting responsibility for taming decades-high inflation ahead of the November midterms. And Biden seized on the Oval Office session to argue that while fighting prices increases is a top priority, that the work was primarily the purview of the Federal Reserve. And I want you to see here what's happening. This is positioning, is put the blame on the Federal Reserve and put all the work on them. If they don't bring it down, it's their fault. If they do and crash the economy, well, it was their fault too. And that is a pretty smart move considering. But one thing I want you to realize is you have a Democratic president putting the hands of the economy and a Republican Fed chief. That doesn't seem to make a lot of sense, but that's what's happening. My plan is to address inflation that starts with a simple proposition: respect the Fed, respect the Fed's independence, which I have done and will continue to do, Biden said. It's Biden's third in-person session, which is rather unusual. You don't see Fed chiefs and presidents meet very often. It's rather unusual. Despite what you're about to hear about this being common, it actually isn't common at all. With Powell since taking office, and recalls the stakes when Ronald Reagan met with then Fed Chief Paul Volcker almost 4 decades ago as he sought re-election amid galloping price pressure. Biden has been attempting to show he's maximizing efforts to curb the hottest inflation in 40 years heading into November midterms, in which Democrats risk losing their slim congressional majorities. And so now you see it is a political issue, and this is all about getting re-elected. And if they believe if they can bring inflation down, they can call a big win and say if it doesn't work, well, the Fed screwed it up. And what if the Fed does pull it off? They can say, look, we directed the Fed, we told them to get under control, and they did. And either way, that's the hope that they can hold on to that slim majority or maybe even increase it. The White House has increasingly sought to shift the burden for battling prices to the Fed in public comments, as polls show rising costs are voters' top concerns. In an op-ed published on Monday in the Wall Street Journal, Biden said the Fed has a primary responsibility to control inflation, despite the fact that we'll ignore that the federal government did massive amounts of fiscal stimulus, and state governments are continuing to do soft forms of fiscal stimulus. And if everybody would just stop, that would go a long way to controlling inflation. Even so, the White House economic advisor Brian Deese defended Tuesday's meeting, saying it was standard practice for president and chairs of the Federal Reserve to meet from time to time to share views on the economy. Well, Brian, that is not true at all, and we'll just move on because he's wrong. As the central bank answers to Congress, which has given it a dual mandate to pursue price stability and maximum employment, though presidents do get to select the Fed's 7 governors, including the chair and 2 vice chairs. As a result, White House officials usually try to avoid commenting on monetary policy. And financial markets have swung sharply as investors fret the Fed could trigger a recession in its efforts to tame prices. Officials who admit this will be challenging are aiming for a soft landing that cools demand by raising cost of borrowing on everything from homes to autos, but doesn't push companies to lay off workers. And there's the other key point to what's going on here in this political story is bring the economy down, bring the market down, bring prices down, but don't cause unemployment to go up. In fact, if you can keep unemployment rates low and people finding jobs, they will be able to afford higher prices as those prices come down because wages are looking pretty good. And that is the real story here. Keep the job market going, but bring prices down. And that is something that's probably nearly impossible to do. Because what you start to find out is the stock market is the economy. And here we have the gross domestic product in blue on the left side on a year-over-year rate of change against the Wilshire 5000 price index, the total U.S. stock market on the right on a year-over-year rate of change. And what you see is the U.S. economy. As the market rises, the economy grows. And as the stock market heads lower, well, the economy starts to slow down and sometimes even contracts. And now you can see where the stock market headed at negative on a year-over-year rate of change. Well, that means GDP is headed much lower. But who are they targeting? Well, they're targeting the wealthiest. And here we can see from this chart from the Federal Reserve and Bloomberg that stock ownership concentrated among the richest 10%. And what we see here as a percentile of U.S. households by wealth, that the bottom 90% only own about 11% of all equities, but handle or manage 78% of all consumption. So 90% of the people are 78% of the consumption. But over here, you have 10% of the people owning about 90% of U.S. equities. But those 10% are 22% of consumption. So when you think about what's trying to happen here is, can you lower the consumption of the 90%? Well, maybe a little bit, but a lot of these people, a majority of them are living paycheck to paycheck, and inflation's already a problem. But if you can take the top 10%, cut their wealth down and their consumption down, well, maybe you can bring growth down, bring prices down, and not impact the labor market. But of course, we know historically the odds of that success are pretty low, and the Fed is likely to send things into a massive recession and bring stock prices way down as a result of that. And one thing that shouldn't be crashing when stocks go is your portfolio. I'll put a link up here to Portfolio Shield and one in the description below. You check it out when you have some time. You'll be glad you did, because the story now is all the focus on the labor market. And we got the non-farm payroll report today as employers added 390,000 jobs in May, and the unemployment rate remained steady at 3.6%. Still, the May total was well above the average number of new jobs, which is something the White House wants to see continue being created in the past 12 months when COVID pandemic was widespread in the U.S. The unemployment rate remained at 3.6%, which Powell has said previously will likely go up and is slightly above where it stood before the pandemic. Wages grew at 5.2% on the year, down slightly from 5.5% in April. But one of the challenges we're seeing now is, even though wages are rising and looking like they're peaking and perhaps slowing down, inflation is still running rampant. When we take a chart of average hourly earnings and subtract off inflation, both of them on a year-over-year rate of change, you can see that employees have been making less. They're actually upside down due to inflation. And we go back to the prior recession, the great financial crisis, and we see where inflation-adjusted wages were negative, and then they popped up here. If you know why, well, the answer is really simple, because inflation came crashing down. Payrolls grew the most in leisure and hospitality in May, low-wage jobs, reflecting a shift in consumer demand from goods to services as pandemic restrictions fade. Professional business services, transportation, and warehouse businesses also posted solid gains. The labor force participation rate, which measures the share of population working or looking for work, ticked up to 62.3%, something the Fed would love to see, a sign that plentiful jobs and higher wages are slowly drawing people back to work. But what's really going to draw people back to work is as their wealth gets crushed in the stock market, is people that were relying on those gains to provide for their lifestyle, they have no choice but to head back to work. And one thing that's notable is we look at the labor force participation rate in blue against the monetary base, the Fed's balance sheet, which is shown inverted. We note that as the Fed tightens, and here we can see the monetary base falling, but shown inverted rising, what it means is financial conditions are tightening. It's likely that equity markets are going to come down, asset prices are going to come down, and people are going to rejoin the workforce, which is something the Fed wants, because they've made it clear that they want wage growth to come down. They want to slow down a lot because they believe that we could get caught in a wage price spiral, and they want nothing to do with it. And I know you're thinking, wait a minute, the Fed doesn't actually want me to get big raises? No, they don't. They actually want those raises to shrink and maybe even go away. Now there are signs that the labor market is moving towards a new equilibrium, as there were 11.4 million job openings in April, as we discussed yesterday, a historically high number, but down from 11.9 million in March. The number of job openings per unemployed worker dipped slightly to 1.9 in April from 2 in March, and as we discussed yesterday, is going to head lower due to the high correlation with job openings and the stock market. A survey of manufacturers also released Wednesday found that employment in the U.S. factories contracted slightly in May, and it didn't put a dent in the payroll report, but will in the future, as snapping 8 months of growth. But respondents indicated they still plan to expand their workforces, an indication that labor demand remains healthy, or perhaps that the factory sector is optimistic that things are going to continue going their way. A Federal Reserve survey released Wednesday reported that labor market tightness had started to ease, allowing wage increases to level off. And here let's take a look at the ISM Purchasing Managers Index, and here you can see employment. Now the way you read this is 50 is unchanged from the month before, above 50 is an expansion, below 50 is a contraction, and here we see a very just super slight contraction, 49.6 in employment from the prior month, showing that really employment in the factory sector is stagnating, but notably the overall index expanded at a faster rate at 56, new orders expanded at a faster rate, production expanded at a faster rate, supplier deliveries expanded at a little bit slower rate, inventories are rising at a faster rate, customer inventories are too low. And that's one of the baffling ones about this, because we're hearing from Walmart, Target, and other retailers, they have too much inventory, but yet here in the manufacturing sector, they're saying their customers have too little inventory. Doesn't make a lot of sense. As we see prices expanding at a slower rate, of course, the backlog of orders continue to rise. That is a good sign, but also a potential sign of just the supply chain issues that we're facing. And while the Fed database does not have the ISM data in it, I can substitute industrial production here in blue on a year-over-year rate of change and overlay the equity market. And once again, you can see the stock market leads the economy, and industrial production will head lower as equity prices fall, suggesting that both this ISM survey is lofty and likely to come down in the near future. And when we look at total construction spending against the stock market, you see the same story. It's running fairly hot right now, but that story is about to change as the wealth effect is drained. And let's take a look at the service sector, which we're hearing is supposed to be nothing but hot and getting hotter. Well, it expanded at a slower rate, dropping from 57 to just below 56 here in May. Business activity expanded at a slower rate. New orders, though, were up, but employment virtually unchanged at 50.2 from the prior month, suggesting that while there may be demand in the services sector, there really isn't a lot of hiring. We look at inventories, they're growing at a slower rate. Prices paid growing at a slower rate. Backlog of orders growing at a slower rate. New order export orders expanding at a faster rate. Inventory sentiment, although remains too low, continuing the story that we may be facing a massive amount of overproduction as demand goes away. But if you think the White House is panicking now, wait till the Fed pulls off a recession, crashes the equity markets, and we know what happens then. Well, that means the unemployment rate's going up, pink slips are coming, and that is not the news the White House wants to hear. I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.